Hi there, and welcome to Commodities. I'm Lindsay Biscaya. Here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. The International Energy Agency says it is ready to act after an oil stock release earlier this year. Executive Director Fatih Birol says the release in response to the conflict in Iran was roughly 20% of the stockpile. He notes the agency is ready to act if nations want a further injection into the market. In March, the IEA oversaw a pledge by member nations to deploy a record 400 million barrels from emergency stockpiles. And shares of Deere & Co. are seeing some pressure today. The company says it still expects a deep slump in the large agricultural machinery sector in Canada and the U.S. this fiscal year. It warns conditions in South America will be worse than it previously expected. Net income for Deere also saw a decline compared to the year before, while production and precision net sales fell 14%. The European Union's largest copper producer is eyeing mergers amid the energy shift. Poland-based KGHM plans to expand its footprint abroad and wants to strengthen its position in Europe and Africa while monitoring takeover targets in the Americas. The copper producer aims to add annual production from the expansion effort closer to home, which it says would supplement its existing annual mining output in Poland and trim logistics costs. Okay, let's take a look at how some key commodities are trading today, starting with the price of energy. Oil falling today, down by 0.4%, as investors are hoping the U.S. and Iran are closing in on a potential peace deal, with Tehran reviewing a U.S. peace proposal at the moment. You're seeing gas tracking that, down almost 2% at the moment. And if we take a look at where some of the metals are trading today, gold was dropping earlier. Now it's relatively flat. This is among concerns that these elevated energy prices could force central banks to keep interest rates higher for longer. Silver, relatively flat at the moment as well. Copper, too, also, it was retreating earlier as traders are weighing the prospects of that U.S.-Iran peace deal. And if we take a look at where some of the agricultural commodities are trading, wheat futures are down at the moment almost 2%. Widespread rain is expected over the weekend in the U.S. plains, offering some potential relief for droughts in that area of the world. You're also seeing soybean down and corn futures down by 0.6%. Our next guest states Alberta's oil sector remains gloomy despite structural tailwinds. He notes that Alberta oil executives are still skeptical that Canada can overcome ongoing political and regulatory constraints, even after the Federal Provincial Energy Corporation framework was signed. Let's bring in Bob McNally, founder and president of Rapidan Energy Group, with more. It's great to have you join us. Thanks so much.
Thank you very much, Lindsay, for having me.
So you were in Calgary last week. You mentioned oil executives are concerned that the Carney-Smith agreement may still not lead to timely infrastructure projects at this point. Could you kind of specify what some of those concerns were?
Sure. And, you know, it's a really interesting time. I was in Toronto, Ottawa, and then Calgary, and I sensed a lot of frustration in Calgary. They sense that the winds are blowing their direction, all right? I think the world is realizing demand's not going to peak by 2030 for oil and gas. And then this Iran war has shocked the world and will attach a security risk on the Middle East for a long time. And if you take those two ideas together, they're realizing demand for Canadian hydrocarbons is going to go up. And even public opinion in Canada, I understand, is shifting toward developing Canada's energy resources. And so, and you have the Prime Minister, of course, Carney, who wants to show independence from the U.S., wants to see pipeline to the Pacific. So all of those are positives. And then I was surprised, really, to hear that, you know, they fear that they may miss the moment. And there are issues such as the carbon tax that's been agreed to is still onerous, especially for small producers. There's a concern that interprovincial politics, and I won't claim to be an expert in that, could delay the necessary permitting and the selection of a route of a pipeline to British Columbia and so forth. And then there's just a broader concern that Alberta's sort of reduced power in Ottawa because of its lower population makes its priorities sort of endangered when it comes to getting approval from the larger provinces. So I'm just a an American from the South learning about Canada's political system. But for those reasons, I sense that there's concern that Canada or Alberta may not be able to seize this moment.
When you speak with oil purchasers, do any of them actually care about the carbon footprint of a barrel of oil? Because as you know, Prime Minister Mark Carney mentioning that in his remarks briefly, that is a concern.
No question. And I think some investors in Canada see Canada's concern and value that they attach to the carbon footprint, methane reductions as attractive to investors. So what we're going to see is, we're already seeing it, Asia is going to come to Canada and the United States, Asian countries, shocked at the loss of Ras Laffan for LNG. The Persian Gulf now supplies for going on 80 days. This is a load-bearing assumption in global energy that is toppled, and Asia is the most vulnerable. And so they're going to come to us, the Americas, looking to invest with new enthusiasm, with checkbooks open and so forth. And I think that creates the optimism. And I think they will, these Asian, they will even prioritize investments that have a value to some decarbonization. The question is how much, and will it be just a straight up reasonable decarbonization, or will climate change be used as a reason for other entities to sort of slow, stop, and reverse the necessary infrastructure build out? I think that's the broader concern.
And I take your point, too, that within Canada, you're hearing concerns that maybe Canada missed the mark, is not within the timeline to capitalize on this. Do you foresee Washington, though, actively opposing any infrastructure designed to increase Canadian energy exports to China, if that were to actually happen?
Yeah, that's a great question, and I got that a lot. So I don't think the U.S. Trump administration is going to be concerned about Canada's move to the Pacific, if you will, especially a tie-up with China on energy. And that issue is complicating and is going to complicate this USMCA issue. Look, we expect the U.S. is not going to withdraw from the USMCA. We're likely to have a painful extension later this year, or early next, or more a series of annual reviews. I think we're kind of status quo on that. I don't think the president early in 2024 kind of backed away from tariffs. I don't think we want to disturb the energy relationship with Canada. I think there will be opposition as long as there's Republicans in the White House for Canada developing these resources. Now, if the left comes back after the next election and we have Democrats in power, I think they'll be less concerned about a Canadian build-out of energy infrastructure toward the Pacific and China. You may have more challenges, though, getting those cross-border permits, because they will likely follow President Trump's example and use executive powers, but now to hobble energy, and so forth. So I think Canada will have a different set of issues. But again, I don't think Canada's looking at Western energy options is going to torpedo or undermine the kind of status quo we have right now, which isn't that great. We're kind of just staring at each other, but I don't think it gets much worse.
And just lastly, before I let you go, let's be quick with this last answer, but we're seeing Asia importing U.S. oil at record levels with the Strait of Hormuz closed. Do you feel Canada maybe is missing out on an opportunity there as well because we just don't have the infrastructure?
Absolutely. Asia is so thirsty and dying for energy, and you have TMX, that build out helps. You have a little bit, but that's why the eyes were pretty wide in Alberta. They just see that opportunity to sell those hydrocarbons west to Asia during this crisis, when future crises happened, and so forth. So it's a great time, and they just want to make sure they catch the lightning, if you will.
For sure. Okay, Bob McNally, founder and president of Rapidan Energy Group. Always great to speak with you. Thanks so much for joining us.
Thank you.
Up next, Keyera, AltaGas, and CN Rail have announced plans to proceed with a new rail terminal project to support Asia's increasing energy demand. We're back in a moment with that conversation. Keyera, AltaGas, and Canadian National Railway are collaborating on a $240 million rail terminal that will transport approximately 45,000 barrels per day of propane and butane from Fort Saskatchewan to West Coast export facilities. Our next guest says exporting directly to Asian buyers will enable Canadian producers to achieve significantly higher profits. So let's bring in John Stevenson, oil and gas analyst at Granite Point Research. Thanks for joining us.
You're welcome.
What problem in Canada's energy export system right now is this project going to be solving?
Well, it's going to be solving a couple. One is egress. One is overproduction. That would be the second one. So, we're seeing quite strong natural gas production in Western Canada. It's increasing every year, and we need a home for that. And we need a home that pays the highest dollar of revenue. And so, from natural gas comes LPG, and that's what this project is addressing. And I think Asian markets are just insatiably hungry for this sort of product, and to get it there and get it there efficiently and in fairly quick order, that will help. And we have several built-in advantages in terms of shipping time to Southeast Asia vis-a-vis the U.S. Gulf Coast. We're 60% quicker, so that translates into lower landed costs, but more net back, higher margins, et cetera, higher revenue for our producers.
Is rail the right solution here for this problem?
Well, pipeline's the right solution, but I think rail's the solution for right now. I mean, if you look at the in-service date, it's in mid-2028. You're not going to even get pipeline approved probably before then, and then it has to be built. So, and we're talking relatively small volumes as compared with bitumen pipeline or natural gas or LP, natural gas liquids to the West Coast. So I think this is a logical solution. And, it's got great partners. Keyera has great partners in AltaGas and CN Rail.
I wonder if you can talk a bit more about the demand in the global LPG market right now, what that looks like, and how it's shaping this specific investment.
Sure. LPG is used primarily for heating. And so we have parts of the world like China, Japan, South Korea, et cetera, that are very energy short. They have very little to none. Well, certainly Japan has no real domestic, oil and gas production. So for countries like that, they desperately rely on gas and derivative products and oil from countries like Canada. And of course, they've gotten a lot of it out of the Persian Gulf region. But as we know, with the shutdown of the Strait, that's something that's just really not accessible to them anymore. And so, like any consumer, they're going to start diversifying their suppliers. And Canada is a very logical supplier for this, rather, because we have these huge reserves, and we have this market that really wants this. We're also 45% faster, cheaper than other alternatives, including out of the Arabian Gulf. So even if you could get it, we're still a better alternative. So we have, the identical product at a better landed price for the consumers in Asia.
Do we know at this point who the upstream producers supplying the propane and butane for this project would be?
Well, they'd be anyone feeding into the Keyera system, which would be all of the major ones would be included in that. Those would be some of the producers, but it will broadly benefit it. Anytime you have these options, and you can raise the price, because right now, we really go off this Mount Belvieu pricing, which tends to be kind of depressed in the Midwest of the U.S. And anytime we have options with additional ways to get product to higher margins, higher paying consumers rather, that increases margins for producers, increases optionality, increases prices that might, even for the ones, the barrels that are going into the U.S. domestic market. So it's a win-win-win in many senses, because it really raises the floor price for these commodities. And that's something our producers really need.
What, though, are the time and cost efficiencies resulting from bypassing the Midwest markets and then selling directly to the Asian markets instead?
Well, I think what you do is you eliminate the lower price point. That's really what you avoid. In part, you're still going to have most of your production going into the U.S. That's been the case for gas and oil and certainly LPG as well. So that doesn't really change, except it gives us optionality particularly in these times when all of these commodities, particularly gas in Asia, LPG in Asia, and oil is extremely valued and going for much higher prices than would be seen even on the futures market. So I think what this does is give producers the opportunity to have very high netbacks for those barrels that end up going overseas, and it really gives us a stronger negotiation position than just having really the one client, which is really what we've had for decades.
Okay, we'll have to leave it there. John Stevenson, oil and gas analyst at Granite Point Research. Appreciate your time and your insight. Thank you.
Thank you.
Coming up, oil slips as markets await progress on a U.S.-Iran deal. More on that next. Welcome back. Oil prices were higher this morning as investors wait to see whether talks between the U.S. and Iran will translate into a tangible peace deal. And to share his thoughts on the Canadian energy sector in the wake of this conflict, we were joined by Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management.
Obviously, the Trump administration, the U.S. government, I think would like to be done with this, but I just don't think it's that simple. And they can't retreat in a way that sort of makes them look bad, right, and makes them look weak. And if they were to retreat now, I think Iran would have more control over the Strait of Hormuz than the global community wants. And so I think it continues to be a bit of a stalemate.
And so where does this, we saw oil retreat for a couple of days. It looks like it's on its way back up today. Where does this leave the Canadian industry?
I think the Canadian industry is in great position. And oil prices aside, I do think that eventually we will get some resolution here and eventually barrels will start flowing out of the Strait of Hormuz and things will be somewhat more normalized, although I doubt we're going back to the 20 million barrels a day. And so with that in mind, the Canadian industry has a great opportunity here to expand egress potential. Now, things are back on the table. We have a modified Keystone XL back on the table. But the thing that I'm much more excited about is on the natural gas side and natural gas export. I think this crisis is much more acute in gas because of the lack of storage capacity for natural gas and just the way that commodity moves around the earth and how concentrated supply was in Qatar. I think the world is now looking for more points of supply, and Canada has a big part to play there. And I think with Shell coming back into Canada is a big vote of confidence that says, hey, there's going to be some more investment in the Canadian industry, and that is exciting for us as infrastructure owners in Western Canada.
What would you like to see Canada's role in natural gas, or Canadian companies, their role for natural gas?
I mean, I just think we have such an opportunity. I think we could be an exporter of 5+ BCF a day, billion cubic feet a day. Right now, we're a little over 1 with LNG Canada Phase 1. So LNG Canada Phase 2, we have Cedar LNG coming online, a smaller project, wood fiber. There's a few smaller ones. There's an Indigenous-led project as well that's quite large. I think we could do all of them over time, and that would be, we have abundant natural gas supply that's very, very economic. We have a shorter shipping distance to Asia and a cooler ambient temperature, which means that there's less energy required to cool the gas. So, longer term, we really need to get something going east as well, and that's another opportunity. So if we're actually in a position where the existential threats that have been presented to us by the U.S. With trade negotiations over the past couple of years and just what's happened with the global energy sphere, I think Canada has a big opportunity to play going forward, and hopefully we're ready to do that.
And how about, let's talk the pipeline for a sec, that the agreement that was signed between Ottawa and Alberta, and then the Prime Minister was in BC yesterday trying to make amends there and try and mend fences because that's a roadblock for it. Do you think he can work through that? Do you think we can get that pipeline through?
I don't. I'll believe it when I see it. This is a fool me once, shame on me, fool me 100 times. You can't keep going down that road, right? So I don't think we're going to see a greenfield West Coast oil pipeline built, and I don't necessarily think we need one. I think if this Bridger pipeline gets done into the U.S. and that would be more than enough to satisfy demand for quite some time. it would be better for us to diversify our customer base and have more going to Tidewater. But I do think that the road is just too difficult for any company, any private company to take on, and therefore then you need government guarantees, and then we're into, how long do terms last and who's in charge of the province versus the federal, and we're into a bit of a mess there. So, again, never say never, but I'll believe it when I see it.
All right, let's talk about some of the names you like. Enbridge, AltaGas, Pembina Pipelines. I always want to say Pembina Pipelines. What do you like about them?
Again, I just think that all of them have opportunity here, especially, Pembina and AltaGas on the natural gas side. There is, really strong demand in Asia. Asia has had cargoes bid away from them now twice by different crises. First, the Nord Stream and Russia-Ukraine crisis, and now the Iranian-Qatar crisis in terms of natural gas. I think we have willing customers over there for our product, and so I think, again, in terms of the natural gas transport, processing, export, there's a lot of opportunity. If we go from, again, 1.5 BCF a day to, say, 5.5 BCF a day, that's a more than 3x increase. You've got more volumes that need to be handled, and that's where we're more focused on the volumes, right? We're not so focused on the pricing. More volumes flowing through pipes, more volumes flowing through plants means more plants that need to be built, means more revenue for these companies.
All right, what are your top producer holdings right now?
We like, obviously, Canadian Natural Resources has been our top holding, and it's funny, it was a source of funds to fund, trades into other, Cenovus and Imperial Oil primarily over the past couple of years. But if you look at this company and what they've amassed, they were big buyers of different assets. They bought Painted Pony for, I don't remember what it was, $4 a share back in the depths of the pandemic. This is a company that acquires countercyclically and produces a lot of cash flow when the cycle is high, and that's where we're at right now. Their net debt position, going down to that $13 billion number where they start to return 100% of free cash flow to shareholders. They're saying 2027, if the strip starts to come up to where the spot prices are. The strip is still down in the $70 to $80 level. That's going to keep coming up as this crisis goes on. We saw the oil inventory draws from the U.S. yesterday. Massive 17 million barrels came out of storage in the U.S. last week. That's going to push that long end price up, and that means that's going to happen sooner for C&Q. So we really like that holding. ARC was our other biggest holding, ARC Resources, which has been acquired by Shell, I mentioned earlier. So we are replacing that with Tourmaline over time. We'll wait and see how this ARC deal goes. It's 75% stock, so it's a difficult thing to know, should we be selling here and moving into the next thing, or waiting and seeing what happens to share prices globally.
That was Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Thanks for watching Commodities. You can always email your story ideas to commodities@bnnbloomberg.ca.